and we're delighted to have you all here. I believe that at the end of today's session, we would have had a very, very insightful and impactful dialogue. And I hope that it will help move the financial inclusion needle ultimately. Before I hand over to my colleague, Dr. Nkem Iheanacho and Mr. Tayo Murtala, who will be handling today's presentation and facilitating the discussion. I believe we're all familiar with the housekeeping rules, but I'll just mention them again. We kindly request you to please mute your microphones when you're not speaking. This will help us minimize background noises and interruptions. You're also welcome to use the chat box throughout the session. You can drop your comments, your questions, and observations in the chat box. I'll be happy to take questions subsequently, maybe after our presentations. So if you'd like to speak, you can use the raise hand icon to indicate, and I'm sure my colleagues will be happy to bring you up to speak. So at this point, I'd like to thank us once again, and I'll hand over to my colleague, Dr. Nkem Iheanacho and Tayo, to take us into the session proper. Thank you very much.
Good morning, everyone. Good morning, Timothy. It's a pleasure to be with you all this morning to discuss this very interesting and intriguing topic in my view. So we're going to get on straight with the conversations. So this morning, very quickly, we're going to be discussing the topic, collaborations in the Nigerian digital financial services space. This discussion is brought to you courtesy of the Sustainable and Inclusive Digital Financial Services Initiative here in Lagos Business School. Now, what are the key objectives of this session? We're going to try to understand the role collaborators play in the financial services space. We will understand how collaborations are consummated. We would understand the key considerations in entering into these collaborations, common challenges with the collaborations. And at the end of today, we hope that participants would have an open platform to discuss the different types of collaborations you encounter in this space. We hope we're also going to achieve a common understanding of the challenges with collaborations. And then we also hope that we are also going to be able to learn from each other on our experiences in forming these collaborations, the challenges we've encountered, how we've structured these collaborations, internal supporting organizational arrangements we've been able to put in place to support the collaborations, and then regulatory enablers and inhibitors that have also acted against these collaborations. So we hope at the end of today that we're going to be able to define this phenomenon. And going forward, we hope to be able to define a stream of work that will help improve the general understanding of the ecosystem as to how partnerships work and how partnerships should be consummated. Now, in a nutshell, what are collaborations? Collaborations are any cooperative effort between two or more independent organizations to develop, manufacture, or sell products and services. Now, ladies and gentlemen, you will agree with me that in the challenge of closing the financial exclusion gap in Nigeria, there's undisputedly a need for multiple collaborations by several organizations at several levels. So to achieve, for instance, an effective payment, you first of all need a financial service provider that would serve as a store of value to sort of store and keep the value. You would need a payment services provider that would serve as the switch. You would need a mobile network operator that would provide the platform across which the transactions, the communication and the interactions between the multiple stakeholders in the ecosystem that would ultimately lead to the delivery of the service. You would need the collaboration of technology providers who would provide the technology resources that would ensure seamless connection and communication within the ecosystem. And then last but not the least, you're going to need an agent network that would make it possible and seamless for this service to be distributed and made largely and widely available in the market for the consumers. So collaborations are a very essential part of our work in this space. And it's very important we begin to discuss how these collaborations happen, what the challenges with the collaborations are, and how specifically we should improve these collaborations such that we're able to achieve better results in the collaborations. Now, ladies and gentlemen, as we go ahead with the presentation, please feel free to drop your questions in the chat window. Also use the raise a hand feature. If I'm not able to see your hand, my very exciting colleagues, Emmanuel Omotayo, Timothy, and Samuel will draw my attention to your hand, and I'll be able to, invite you to the conversation to also share your perspective. Is that fair enough? Are we all together, or am I disconnected?
Yes, we are.
Excellent, excellent, excellent. I just wanted a sign of life. Now, what are the motivations for firms to actually go into collaboration? Why do firms collaborate? Is it necessary to collaborate? So, like I've just described, in our space, collaborations are inevitable. It's virtually, let me not say virtually impossible, but it's extremely difficult and challenging for any single provider to acquire and deploy the resources at scale required to successfully create and deliver digital financial services. That means that it is almost inevitable that some form of collaboration or the other would happen. So this collaboration can either be voluntary, or this collaboration can be regulator induced, or these collaborations can also be market induced. So first of all, firms collaborate to exchange technology. So you have a technology, or rather you require a technology, and you collaborate with a firm that has that technology. And then that collaboration leads to a transfer in the technology to your own organization. And that technology also helps you improve what it is you offer your customers. Collaborations also help improve your competitiveness. So for instance, you could be trying to gain access to a certain market segment. You could be trying to increase scale. And then you would actually require some sort of collaboration to help you achieve that level of competitiveness that makes it possible for you to profitably operate in that space or serve that segment. Now, sometimes industries could converge. And then when industries converge, so think about the Nigerian banking industry in 2004, when ATMs were introduced. It became inevitable that all banks key in and make their platforms accessible to each other. And that gave birth to the likes of InterSwitch, and the rest, as you know, is history. The payment services space has also evolved. So when industry convergences like this happen, collaborations that sort of facilitate interoperability, facilitation of products and services, and then democratization of those products and services become inevitable. Sometimes collaborations are entered into to help firms gain access to new markets. Sometimes it's also to help firms enter into new businesses. So you have a mobile network operator who has decided to get a payment service bank license, and that mobile network operator now has to collaborate with other firms in that space to make it possible for the mobile network operator to successfully offer that service. Now, collaborations too sometimes are entered into to help firms create new products. So we've talked extensively about the fact that a lot of us as financial service providers should think more carefully about the kinds of products and services we offer to the unbanked and the underbanked consumers, and also think very carefully about the processes that help bring these products to life. Also, collaborations help avoid predatory competition, Because sometimes when firms collaborate, what that means is that these firms are able to pool their resources together and offer a stronger front in the market that, for instance, leverages on economies of scale and economies of scope. That way, predatory competition that is trying to come in is not able to stifle or kill the core operators in the market. Gain access to complementary resources. So collaboration helps you gain access to resources you typically wouldn't have. So for instance, you're thinking about a new payment service operator coming into Nigeria. Now that payment service operator doesn't have the resources to scale and build and roll out a large agent network. That payment services provider can now decide to partner with another firm that has an agent network and offer these services through the agent network. Pool resources, skills, and risk capital. So sometimes it's also good for firms to collaborate, to pool resources together, especially when the efforts or the activities they are going to be carried out are going to be activities that will result in gains for all the players in the industry. In this case, it's always better to pool the resources together and act as one industry. Collaboration also helps you pool skills, pool risk capital, share and reduce risk rather than carrying all the risks alone, share research and development expenses, and then also achieve economies of scale. Now, what are some synergies that can actually motivate these collaborations? So one very important synergy is exploiting economies of scale. So what happens in this case are that firms are able to exploit these scale economies and deploy these scale economies in growing, in lowering the cost of their products and services, in reaching more customers, and then in also activating things in strategy we call network effects, where you're making your product available to multiple customers. And because multiple customers are using your product, it makes that product a lot more attractive in the market. And then collaborations can also help you learn from competition, manage risk and share costs, achieve low-cost entry into new markets. So for instance, you want to go into a new market and you're asking yourself, what are the risks of going into this market? How best do I go into this market? Can I find a partner that will make it possible for me to go into this market, provide a platform through which I can reach the consumers in this market, and then also offer me learning and knowledge that helps reduce my time to market and reduce my investments in negotiating the learning curve. Collaborations also offer low-cost entry into new industries. So it could be an existing market in which you operate, like I've explained in the case of a mobile network operator. First of all, creating or becoming a super agent, like in the case of MTN, or then going the full hog to get a payment service bank license, like in the case of 9Mobile. So these are existing operators who are entering into new industries or even new industry segments. And collaborations can also help manage uncertainty. And in this market, there's significant uncertainty. There's significant fear among the industry operators, fear of making investments, and fear that these investments may not yield the desired results if and when these investments come to life. So how do collaborations add value? So there are multiple ways collaborations add value. So I'm just going to mention a few of them here, and then we'll move on. So first of all, collaborations can actually help improve current operations. Collaborations can change the competitive environment. Collaborations can ease entry and exit into a market. Collaborations can help achieve economies of scale from successful alliances. Collaborations can also provide the opportunity to learn from partners. Risk and cost is shared between partners. So what that means is that your unit investment cost of going into that new market, launching that new product, activating that new service, or engaging that new customer segment is shared between the various partners that are collaborating. And that way your single investment of getting into that venture, getting into that customer segment is reduced or shared. Collaborations also help give access to supplementary services. So for instance, you want to expand the scope of services you're offering, and you actually want to collaborate with other providers that would help you, for instance, bundle your offerings. And these types of collaborations happen a lot already in the financial services space. So if, for instance, today you see banks and insurance companies who come together to bundle their offerings. So you you open a certain type of bank account. That bank account you open automatically offers you insurance services, and in some cases offers you access to use a lounge in the airport, offers you discounts in certain hotels, airlines, etc. So collaborations are things that can help you increase the utility of your product, improve your value proposition, and even make you a lot more attractive to multiple or different customer segments. Collaborations can help increase your brand awareness. So for instance, you are a lower brand organization, or rather, well, let me not say a lower brand, probably you don't have significant brand power, and then you want to scale and achieve impact. You might actually want to collaborate with an organization that has the resources, the firepower, and the muscle to promote the brand and push the brand further and deeper. Collaboration can help you assess a new customer base. So, you have certain customer segments that exist. And then today you're asking yourself, how do I get into new segments? And this happened a lot in Nigeria when the commercial banks actually wanted to go retail. And the question is, how do we go retail? How do we sort of come down and begin to serve those segments of the market that hitherto we couldn't serve? So collaborations can help give you the resources, give you the tools, give you the channels, give you the distribution networks that can enable you attack or engage that new customer base. Collaborations can also provide a shared business risk opportunity. So as against, like I said earlier, carrying the risks alone, collaborations can actually help you share these risks. So by the way, you're going to have the slides at the end of the presentation. So there's absolutely no cause for alarm. Now, when you want to get into collaborations, there are a couple of things you need to pay attention to. The first of them is that you need to understand your capabilities and your needs. So first of all, you want to ask the question, where am I taking my organization to? What new customer segments do I find attractive? What's my vision and mission? What are my goals as an organization? And in achieving these goals, do I really need a collaborator? If I say yes, for how long do I need this collaborator and why? How big is the payoff? How likely is the success? What's the best form of collaborating? And, in collaborating, you can go, or rather you can achieve collaborations through alliances. You can achieve those collaborations through establishing joint ventures where you're actually going to go ahead and incorporate special purpose vehicle project companies that would have equity holding from the multiple partners in a new JV company. And, you have that JV company go ahead to carry out the activity for which it was set up. And then it could be in the form of partnerships, where you actually have multiple players coming together, or two players coming together to say, yes, this is the basis on which we will partner, and this is how we're going to go ahead achieving or facilitating this partnership. Now, once you are clear on your capabilities and needs, the next question is, who is going to be an appropriate collaborator? And in trying to answer this question, the first point is, am I able to find a collaborator that shares my aspirations for this venture? So once the collaborator shares my aspirations and my objectives, that's the first good sign. The next question is, does this collaborator have the necessary skills and resources? Will I have access to these resources? And then, am I going to be compatible? How am I going to be able to integrate the cultures of both organizations? How will I seamlessly knit together the various parts of the different organizations to create a larger front that makes it possible for us all to achieve our combined objectives for which the collaboration was entered into in the first place. And now the next question is, what's going to be the structure of the collaboration? What's the scope of the activity? What strategic freedom am I going to make available or accessible? What are going to be the duties, the payoffs, and the responsibilities of each parent? What's going to be the managerial role of each collaborator? Now, once the structure of the collaboration is clearly cut out, the next thing is, how do we now do the deal? How much paperwork is necessary? To what extent are the participating organizations going to be able to trust each other? How are they going to be able to trust that, all of the organizations will commit to all they have committed, or rather will deliver to all they have committed to delivering? What are the legal considerations? What are the risks? What are the potential liabilities that may come out of this collaboration? And then ultimately, there's a need to agree on an end game. How are we going to get out of this deal? What's the end going to look like? And how are the different organizations going to exit from this transaction? So in making the collaboration work, we have a few recommendations here. And then side by side the recommendations, we're going to also give you some strategic questions you need to ask. Now, the first question is, you need to give this collaboration continuing top management attention. You need to manage the cultural differences between both organizations. Well, let me not say both, between the different collaborating organizations. Because the reality is that these organizations might actually have cultural differences. And these cultural differences could impact the success, the ability of the organizations to deploy the resources, and could lead to failure of the collaboration, or even result in the inability to achieve the different objectives set out. Now, it's also important to watch out for inequities. So what are some inequities that may actually affect this collaboration? And then last but not the least, it's necessary to be flexible. So as you go into this collaboration, realize that things may not be perfectly black and white. There may be multiple shades of gray. So there's a need to achieve and maintain some level of flexibility as you go ahead and you try to execute. Now, what are some strategic questions to ask? Are we getting the most out of this collaboration? Do we have to manage the collaboration differently depending on where we are in our life cycle? If so, how do we gauge where we are in the life cycle of the collaboration? What are the key actions we need to take at each stage? And how are these key actions going to impact this collaboration going forward into the future? So a sort of systematic process of building a collaboration would start from setting a collaboration strategy. So what's going to be my strategy? What are my core objectives? What do I want to achieve? Do I need to collaborate? And then the next is, I need to set criteria and select a collaborator. So what are the things that would help me identify a suitable candidate for collaboration? How do I assess the suitability of the collaborator's resources, the complementarity of the collaborator's skills, the collaborator's access to information? How do I also evaluate the collaborator's culture, the collaborator's discipline when it comes to execution? And then how do I go ahead to structure the collaboration? How do I manage the collaboration? And then what matrices would I put in place to constantly evaluate the collaboration for success? So the various stages would go from initiation, formation, growth, maturity, and then reinvention, declines, or exits, as the case may be. At the initiation stage, you typically have a dedicated team leader. At the formation stage, you have significant stakeholder interaction. Now, dedicated team leader is from each of the collaborating institution. So it's not a dedicated team leader from just one institution. And then at the formation stage, all of the stakeholders would have to come together, interact, fine tune, and then develop that cohesive culture that would speak to their needs and their circumstances. Now, the next stage is growth. How are they going to innovate to drive growth? Maturity. And then at the maturity stage, the focus is going to be more on value-driven ideas and improvements. And then, of course, at the maturity stage, things sort of stabilize, and it's very clear as to what the potentials of this collaboration are, to what extent the collaboration can add value, and to what extent the collaboration cannot add value. And then the last stage is the reinvention, the decline, or the exit. So here you need to reinvent to get to the next level, form a spin-off organization, or ultimately everybody can actually part ways. Now, managing collaborations aren't a walk in the park. I'm going to present today about 2 case studies of some challenges with collaborations that happened in our continent. And I'm sure, of course, in your respective organizations, you also have examples of different collaborations that may not have added as much value as was intended initially. Now, the first is integrity. So there is a need for strong clarity of what each collaborator is bringing to the alliance. So most times, competencies are often misrepresented. So it's either that the competencies are misrepresented, or that the intention or willingness of the collaborating organization to release these resources may also be misconstrued. Now, there is also a need, or rather there is a likelihood that collaborators may fail to commit the resources and capabilities as promised. So collaborators would find it very easy to come out and say, I will do this, I'll do this, I'll do that. I'll put this on the table, I'll put that on the table. But when push comes to shove, it becomes difficult to actually see collaborators who are able to follow through on these commitments. Now, one collaborator may commit heavily to the alliance while the other does not. And, you know, things like this also lead to questions like, am I being cheated? Is there a need for me to discontinue or exit from this collaboration? Must I continue with this collaboration, etc.? Now, there is also the case of lack of trust or experience between collaborators. Now, sometimes another challenge could be incomplete lead or lag measures of success. So sometimes it's also very good that the KPIs of the collaboration are clearly defined so that everybody understands, what does success look like? What do I need to do to succeed? And, you know, what do I do to also tag along and get the cooperation from my other partners? And then last but not the least is culture clash. So executives may also see the alliance as an extension of their main business. So why do I have to subject myself to this level of scrutiny or to this level of transparency in this collaboration? Because sometimes when these levels of transparency or processes are not put in place to keep each collaborator honest, are not put in place, what that leads to is undue suspicion, and then gradually communication breaks down and the collaborations begin to fail. Ladies and gentlemen, I hope you are still with me, or have I lost you?
Yes, we're still with you.
We are together.
Yes, we have. Okay.
Excellent. Excellent.
We are with you.
Excellent.
Well, with you.
So I'm actually trying to round up my conversation.
Yes.
Okay, Oladele, can you go on mute? Okay, thank you.
Yes, I'm with you.
Yeah. Thank you. You can mute now because of the background noise from your end. Yeah, thank you. So let's look at the first case, which is the case of Equity Bank in Kenya. And this is going to be a case of when banks and mobile network operators compete. Now, Equity Bank, as you may be aware, is in many respects Kenya's largest bank, at least when you measure by the number of deposit accounts held. Equity is Kenya's largest bank. When you put a couple of other indices like profitability, asset base, yeah, they begin to compete with other banks like Barclays and KCB. Now, in 2006, Equity was able to reach their 7.1 million customers through their network of 165 branches. However, the expansion of ATMs earlier in 2004, prior to the 2006, gave Equity the first mover advantage through technology assisted channels to actually extend their services and reach a lot more customers to other areas where banks were yet to reach, or where banks were yet to put brick and mortar branches. Now, the anchor of Equity's mobile channel strategy was the bank's product called Easy 247 service, launched in 2007 with the aim to actually provide bank clients with a USSD-based mobile application for transactional services linked to their bank accounts. Around the same time that the leading mobile network operator, which at that time was also state-owned by the government of Kenya, well, not state-owned, the state-owned majority shareholding in Safaricom at that time, Safaricom also launched the product called M-Pesa. Now, one of the things that happened at that time was that the 2007 banking regulations did not allow banks operate through third-party agents. Now, in contrast to the fact that banks in Kenya were not allowed to operate through third-party agents, Safaricom, which happened to be a mobile network operator and not a bank, was given an informal permission by the Kenyan commercial banks to roll out agents, and this helped Safaricom at that point to quickly create an impressive, massive, and extensive mobile agent network, deploying and democratizing their M-Pesa product. Now, this M-Pesa product has been a product that has attracted attention globally. It's been a subject of multiple research studies, case studies, to mention but a few. Now, faced with the frustration of their inability to launch their own agent network and the fact that this agent's network exclusivity at that point in time was granted to Safaricom by the Kenyan Commercial Bank, Equity entered into partnerships with multiple mobile network operators. In the one part to achieve that access to multiple customers and extend their mobile financial services service through a channel that Equity could not create on its own, which in that case was the agent network. So banks were barred from creating the agent network at that time. So Equity partnered with Safaricom at that point to create a product called M-Kesho, which was a unique Equity Bank account linked to the Safaricom M-Pesa e-wallet. Equity also partnered with Orange to create Orange Money, which in that case was an Equity Bank account linked to an Orange Money application, which was marketed exclusively by Orange. And finally, Equity partnered with U-Mobile2 in Kenya to create U-Cash, an exclusive e-wallet account for U-Mobile customers. The truth, ladies and gentlemen, is between 2007 and 2011, when all of these partnerships happened, none of these partnerships evolved or resulted into any robust implementations. I mean, I recall personally doing some work for Equity Bank in 2012, and the frustration was very livid across the bank as to how they were unable to actually achieve the bank or the box they expected from these partnerships. Now, food for thought also for us is how successful were partnerships between mobile network operators and commercial banks in Nigeria, aiming to actually extend financial services through mobile network channels prior to the establishment of the payment service bank regime in Nigeria. I'm not going to open that up for discussion yet, but I just want us to reflect and think about that. Now, in June 2012, or rather in 2011, the Kenyan Commercial Bank made a reversal. And that reversal led them to issue agent banking guidelines, which now made it possible for banks to actually create their own agent networks. And what this automatically resulted in was that Equity now rolled out its own agent network, rolled back from all of these partnerships, and then invested a lot more in partnering exclusively with mobile network operators or collaborating with mobile network operators, essentially just to use their channel as a medium for transacting. So it wasn't a case of collaborating to co-create a product or co-create a solution. Equity now rolled back and invested more in building its own agent network. And remarkably, in June 2012, 25% of Equity customers were conducting all of their bank transactions at the agents on the mobile channel platform. So the lesson here is that Equity Bank did not succeed in going through all of these partnerships, but then when it became possible for them to create their own network, they automatically created their own agent network, and they've been a lot more successful operating and faring on their own. So sometimes, when regulators try to define how the market operates or define how the collaborations should happen without effectively looking at the broad interests, the objectives, and the capabilities of all of the partners in the market, it can actually impede market development. That's the lesson here. Now, the second case I'm going to talk about is MTN Ghana. And this is a case of when a leader is forced to follow. Now, MTN launched the MTN mobile money product in Ghana in July 2009. And this product was launched as a partnership between MTN and 9 different commercial banks. This service was also branded exclusively under the MTN banner, using the MTN yellow logo and MTN umbrellas. I recall I was in Douala in 2011. And the promotions, the branding, the presence was significantly MTN. And what was MTN trying to achieve? That first mover status in response to competitive pressure in the mobile communication sector. Pressures, average revenue per subscriber per month was in steep decline in Cameroon at that time. There was significant supply of telco services. So telcos were actually looking for ways and means at that time to diversify, create new products, create new revenue streams, and then offer new products to existing customers and sort of use their existing channel to sell multiple services. Now, at that time, the Bank of Ghana, which is the central bank at that time, issued regulations that permitted only licensed financial institutions to launch mobile financial services, holding them responsible for agent network management, customer acquisition, and individual account management. And at that point, mobile network operators were prohibited from filling these functions. So mobile network operators were not allowed to set up or create agent networks. They were not allowed to acquire customers. They were not allowed to manage whether virtual or interest-paying customer accounts. And because of this, MTN had to initiate discussions first with a single bank that at least partly shared its objectives at that time to reach the mass market customers. However, a little bit into the rollout and the implementation of that initiative, the Bank of Ghana amended regulations and mandated that a minimum of 3 banks must exist in any branchless banking partnership. So what that means is that as a mobile network operator, in creating a branchless banking partnership, you cannot partner with a single bank. It has to be with 3 banks. So that meant that the partnerships must have at least 4 institutions, a minimum of 4 at that point. And this 4 must include a minimum of 3 banks. Now, what happened? The essence and the aim of the regulation was to promote a many-to-many interoperable system, which would actually allow for seamless transaction flows between banks and mobile network operators offering mobile financial services. And in practice, regulations deprive not just MNOs, but also banks of exercising robust leadership roles, requiring banks to actually assume the legal responsibility and the key roles in the implementation, and then also undermining the bank's commercial incentives to play these roles by creating a free rider problem. Because the free rider problem is that because this is going to be a partnership by 3 banks and a mobile network operator, any investment made by any bank is going to be an investment that will be shared by all the banks. So it becomes a case of what's the incentive for me to invest more than this other partner? And if I invest more than this other partner, what's going to be my gain? What's going to be my loss? Am I spending and deploying resources to create a platform for my competitor to actually go through and deliver? Now, the banks, with few exceptions, were unwilling to play an active part in the key roles that were assigned by the regulation. Now, in addition to the fact that they were unwilling, they were also not willing to make the significant required investments in product development, sales, and marketing, since one bank's investment would automatically generate benefits for all competing banks. Now, this slowed deployment and forced MTN to actually assume that de facto responsibility for most functions in the supply chain. You know, they had to invest resources in agent network development, customer acquisition, customer management, and all of this was to build a customer base and an agent network base, which they technically did not own. And then coordination of efforts across multiple unmotivated partners is also a significant challenge MTN had to deal with. But MTN had to manage that by providing strong leadership. So the main takeaway from this second case is that regulation should also ensure that most motivated players are enabled to compete on a level playing field with regulations proportionate to the risk of products and services being offered. You know, regulators have to be very careful to ensure they don't impede incentives of motivated stakeholders to invest and innovate by prematurely forcing collaborations. So before we go into our breakout, I think we can take any general questions. We're at 10:50 a.m., which is exactly the time. So do you have any general questions before we break out? Questions?
Yes, I have a question.
Yeah, please, Jane, go ahead. Thank you.
Thank you for all the insights and the case studies from Kenya, Cameroon, and Ghana.
Thank you very much,
So
Jane.
the question is, what would you recommend for Nigeria?
That's a very huge question. So when you say, what would I recommend for Nigeria? What would I recommend for Nigeria in what type of collaboration? With what type of institution and towards what objective or what end?
Okay, so I'm sure you're familiar with the case with Nigeria. Nigeria has just not been able to collaborate. There have been different interventions from regulation. So I would want you to, if you were to advise the regulation, how would you want them to, what role would you want, what kind of recommendation would you give to them to
Okay.
guide the relationships amongst these parties? Thank you.
Okay, thank you very much, Jane. That's an indeed insightful question. What I would typically recommend are that our regulators should, look at the market holistically. While they try to balance the challenge of managing risk with managing the need for growth, the need to achieve financial inclusion, and they need to also promote fair market practices and fair competition. There's a very critical need to ensure that they do not force or promote collaborations that are counterproductive. That's the main recommendation I would give. If, for instance, there is a specific case, I can now speak specifically to the case. If you would want to share any specific context for collaboration, because there are multiple collaborations in the Nigerian financial services space. Obed, let's take your question.
Okay, thanks so much, LBS and Kendall. I think this is another insightful section.
Thank you very much.
Just a follow-up question to, so what I was actually trying to look at is to a case study also that look at collaboration that did not work well. And maybe Nigeria would have been able to give us one of those examples in terms of collaboration.
No, there are multiple examples in Nigeria, but I decided to go outside of Nigeria.
Okay,
so that I'll give you people the opportunity to talk about Nigeria.
Because that would have actually helped to address some of the concerns that maybe Jane raised. And also, if we look at it, so I will look at it from multiple aspects, you understand? Okay. So from the CBN point of view, I think they've done a lot. They've done a lot in terms of creating out policies that should similarly create that level for collaboration between stakeholders. They will tell you the fact that, yes, we know that the strength of the telcos is this, the strength of the banks is this, so we feel you should play in that space. But if you look at what happened in Kenya, the example you gave in Kenya, I think there was a strong incentive for both parties to come together to collaborate. And if I look at also, if I want to just think about it deeply in Nigeria, one of the challenges you mentioned in terms of collaboration, when collaboration don't work, is the fact that both parties might not have the same level of commitment to that collaboration. So I think maybe that is another aspect that has actually been a problem in Nigeria. You have a case whereby collaborators are working on a particular service and the service are just level of commitment from both parties is not very strong. So I think it would be actually very good for us to take this home to Nigeria. Because this is one aspect really that has not really worked in Nigeria. Is it just about the regulators? Is it about the parties? Is it about the contract, the way they were written, the way contracts were written or formed? Is it that there's no incentive from both parties to actually collaborate effectively? So I don't know how we can take that back. Maybe we can get some other examples from.
So Obed, you are absolutely correct, which is why in SIDFS we're actually elevating this topic. And, we're giving it the prominence we believe it deserves. Because like you've rightly said, why are we not having the right types of collaborations in our markets? And why are these collaborations not yielding the fruits we desire? So the problems range from the capacity of the collaborators, the level of development of the markets, the regulatory incentives, the motivations and the objectives of the collaborating institutions. So sometimes the regulator wants to achieve an objective, and the objective the regulator wants to achieve does not align with your objective as an operator who has invested your capital. And, if the regulator is pushing regulation this way and, encouraging collaboration in a way that does not give you the kind of return you want for your capital, you would either not have the motivation to continue to invest or to continue to move in that direction. So the reason why we're having this discussion is let's actually better understand the challenges with these collaborations, and let's sort of create a framework that helps us understand how to consummate these collaborations, how to define these partnerships, how to structure these relationships, And you know, what accompanying changes in our culture and in our organizational forms we would require to actually have the right kinds of collaborations. Okay, let me take Bashir. Let me take Bashir before Henry.
My question is on who is an appropriate collaborator?
Mm-hmm.
And you made mention of the scope and structure of the collaborator. How can one determine the scope and structure of the collaborator based on the fact that most of these collaborators, I mean, our experience in iPost, most of these collaborators, when they are coming, what they have on paper is quite different from what they can do when it comes to implementation. How can one determine their structure before going to that collaboration?
Bashir, this is an indeed fantastic question. You know, how do you assess the partner? How do you assess the sincerity of purpose and intention of the partner? How do you assess the partner's resources and skills? And how do you also assess the future of this collaboration? You know, these are very exciting questions. I hope we'll discuss them in a lot more detail during the breakout. Henry, we should go into the breakout in the next 2 minutes. Henry. Tayo, please get us ready for the breakout rooms.
Good morning, everyone. Thank you, Nkem Dilim, for the insightful conversation. I just have a comment, and my comment, just what I want to say is about the regulator, how they respond to collaborations, right? You made reference to what happened in Kenya, you know, the equity case study. It was quite clear from inception. The regulator was quite clear on the permissible collaborations, right? But in most cases, you see that the industry is evolving, right? The regulator might not have a clear visibility on possible collaboration that can just spring up. We had quite one experience even here in Nigeria when mobile money was introduced. The regulator wasn't quite clear on the extent how the providers at that point can collaborate with the telcos. And what we saw, MTN made a kind of a bold move to have more a kind of exclusive collaboration with two financial service providers, GT Bank to be precise, and Fortis at that time. And that partnership was quite good at that moment. You know, we saw kind of an increased uptake and usage of mobile money. The awareness was quite there. There was investment, serious investment from the telco, from MTN. But suddenly CBN had to come strong on the players to stop such kind of collaboration, right? Because they felt that MTN is going above the boundary or something, you know. So for my own stance, what I think is the regulator should, it should as well, before they intervene in any existing collaboration or maybe that market triggered collaboration, they have to look at it from the broader perspective. How is it affecting the market? Is it affecting the market development? Not just to look at it from emotional or maybe what people, the perception, the notion people have about a specific provider, right? So you look at it, how does it affect the industry? Is it affecting the industry positively? If it's affecting the industry positively, then what you need to do is to aid such kind of collaboration, right? And you probably can just put some lines or something extent that they cannot go above, right? Instead of just stopping such kind of such collaboration that can aid market development.
Thank you so much, Henry. Thank you. I mean, you nailed it there. So what I hear you say is the regulator should define the boundary conditions and then go ahead to determine how the regulations should drive the partnerships, irrespective of what the sentiments internally may be or how they may be perceived to be favoring one institution or one industry versus the other. So thank you very much. That's a very useful point. So ladies and gentlemen, Tayo, are you ready for us?
Yes, we are ready. We are ready.
Okay, so do you want to tell us, you know, what the structure of the breakout is, how long we're going to be discussing?
Okay, so we are going to be having 5 rooms, and I've tried to group by industry. I hope, although that's not consistent across rooms, but we managed to do a bit of sorting in that respect. So we have 30 minutes to discuss, and there is a slide. Okay, maybe we have to share
the slide is on now, but I'll share these questions in the chat window now. So essentially, ladies and gentlemen, the 5 questions each of the groups will try to answer is: what are the common types of collaborations you enter into? What institutional arrangements do you have to promote the collaborations? What structures and processes do you actually put in place to support the collaborations? What regulatory inhibitors and enablers support or deter the collaborations? And what are the general challenges you encounter? So since you have 30 minutes, what I would advise you is devote not more than 6 minutes to discussing each of these. And then each group should have a rapporteur that sort of takes notes so that all of those can be collated and brought back at the end of the discussion so that we all can have a plenary. So each group should have somebody actually taking notes so that we can share back and compare notes at the end of the breakout time. So I'm going to drop these questions now in the chat box. Let me just quickly do that so that we have it before Tayo breaks us up into groups. So, ladies and gentlemen, do you have the questions now? Do you have them?
Yes, we do.
Yeah,
okay,
we do.
So
have the question.
Okay, it seems we're all back.
Yeah, Prof. I was just typing a message on the group chat now, asking everyone to send their documents. Can you email it to Timothy? Okay, while we are trying to figure out how to do that, I'll just, you know, let's sort of flag up the discussions. Please, can you email it to my colleague, Timothy? He has just shared his email address with everybody. So what were the strongest points in our discussion? Hello, are we there? Are we all still together?
Yes, Dr. King.
Yes,
we're almost done actually.
Can I make a suggestion?
Yeah, Prof, please go ahead.
Yes, we're here.
Go ahead, Prof. Go ahead, Prof.
Why don't we ask the rapporteurs to just give us a synthesis of what they discussed in their groups so we don't have to silence?
Okay, Prof. That's a very brilliant suggestion. So can we hear from group 1?
They can also share. If you want to share your screen.
Yeah, if you want to share your screen, it's perfect. I mean, if you can share your screen, that's wonderful. So can we hear from group 1? Group 1?
Yeah, that should be. That should be us.
That's Bamidele. That was us, room 1.
Yeah. Bamidele will share. Okay, pending when she shares, I think maybe we should just be talking through so that we don't
I agree with you. Pending when she shares, so, you go ahead.
Bamidele, so I'm also in that group. So Bamidele is going to share, talk about things like what are some of the collaborations we form, and we talk about, interestingly, marriage. That's one collaboration I think a lot of people get into, apart from those who are.
That's very interesting.
Yeah. So, do you want to take it up? It's already up.
Yeah. So, if you all can see my screen, good afternoon, everyone.
Good afternoon, Bamidele.
Okay. So, to quickly just, I think Obed has started. We started from the most basic type of collaboration we all possibly go into, which is marriage. And looking at that, we tried to dimension that along the questions that we were given, the 5 questions we were given. So under marriage, which is a form of collaboration of having 2 or more people coming together to achieve a goal. In this case, the goal is to live forever and possibly have children if they both agree to that. Now, what institutional arrangements do we have to promote this collaboration? We have the family, we have religious institutions, and we have the court of law. Now, the next question on that marriage says, what regulatory enablers and inhibitors support or deter the collaboration? We have family consent. That is actually, we were actually trying to finish off with the typing before we're calling. Lack of family consent can actually deter the success of that collaboration. Now, what challenges do we encounter in the collaborations? For marriage, we have cultural differences, we have finances, we have misunderstanding, lack of communication, disparity in educational background, then of course, communication barrier, we mentioned that. So what structure do we have in place? I think time was against us, we couldn't finish with that. But what structures do we have in place to be efficient communication, continuous efficient communication, and engagement, so that we get the buy-in of necessary families as the need may be, if they come up, if they become a barrier in this case. Now, under professional, what form of collaboration do we go into? There's collaboration with the regulators. There's collaboration with vendors. So you have some organizations outsourcing some of their services. So you even have that most part of their organizational processes are outsourced. So there's constant collaboration with vendors. Then in some instances, you even have collaboration to buy over or to merge or acquire another organization to achieve a common goal. And of course, you have tenured partnership, as explained by one of us, that the collaboration may be temporal. We'll be in this partnership for 10 years, 5 years, 2 years, depending on what the goal is. So for professional collaborations, what are the institutions that we have in place? We have regulatory policies and guidelines, especially in the financial sector. It's something that you cannot overlook. Then we also have internal frameworks. So you have the legal team reviewing SLAs. You have the control and compliance team, making sure that you do not flout any of the regulations. And of course, you have your management board, of course. The collaboration may look nice on paper. Where you don't have the buy-in of your management board, it's as good as the way, it can move forward. Then, of course, we mentioned collaboration with publicity partners, communication and marketing drive, which takes the collaboration out there for the intended audience to be aware of them. Then what regulation enablers and inhibitors support or deter the collaboration? Maybe because I'm from the financial sector, CBN regulations or mandatory licenses or some mandatory requirements could make or mar a collaboration. So where you've identified a partner with the right technical capability, but they don't have the necessary licensing or approvals from CBN, you cannot achieve. Now, lastly, what challenges do we encounter under professional collaboration? Communication is one. Lack of trust and integrity. Somebody mentioned that they come with paper, it looks nice, but when it comes to implementation, it's something else. So lack of trust and integrity is a major inhibitor of professional collaboration or collaboration at work. The capability of the organization to deliver on what the intended partnership is supposed to achieve is also a major inhibitor to achieving the goal of that collaboration. And of course, we mentioned board approval earlier on. Then we had a third category called others, where we mentioned the B2B collaboration, where you have business to business collaborating. We have fintech and bank in this case, being able to move payment from a business to the other. We have that highlighted. Then we have the G2P, government to people. You have palliative, you have incentives that move from government to people to support and drive better economic empowerment. And
the example we started here is like the agricultural sector. So you have the extension workers, you have things that drives that ecosystem. Now, what are the possible inhibitors that we have identified for this collaboration? Legal is key. SLAs need to be kicked off with partnered agents or organizations. And of course, community buying is also very key. Where the government has all the lofty ideas, but the community refuses to buy in, you can't force, you can take a horse to the water, you can't force it to drink. So where they lack buying, where the community lacks buying, it will be very difficult for that collaboration to work and deliver its intended goal. Now, what challenges do we envisage? I think we just agreed that is majorly the same challenge. Where there's no buying, there's no way that collaboration can work. So that's an overview of what we discussed in our group. That's group 8. Thank you.
Okay. So thank you so much. I mean, that's very good. Okay, can we quickly hear from group 2 because we're fast running out of time?
Okay, might I suggest that group 2 should build on? So
okay.
We don't.
Oh, sorry. I didn't even see your chat. Okay, yeah, that's a good suggestion.
So let's build on, so we don't repeat things. So if they've said something that you said, can we build on what's already been said? Thank you.
Excellent. So group 2, group 1, can you stop screen sharing? Group 2, can you share screen and then tell us what is additive, given what group 1 has already said? Group 2, are you there? Okay, while group 2 is trying to get ready, group 3, are you ready?
Yes, I think we can go, right?
Okay, go ahead, group 3, if you are ready to go.
I don't know if you can see my screen.
Yes, I can. Perfect.
Okay, so in my group, we had people from different industry, which was very interesting. So in terms of, so they will also make contribution in case I'm not expressing their thoughts properly. So in terms of collaboration that we enter into in our different industries, we had somebody from the regulatory body that identified that financial literacy program partnership is very key within their own space. We also identify collaboration around identity management with both private and public organization. Then we also have the microfinance bank and the fintech, they partner to provide services and product development. We also identify billers and aggregators with fintech as well that help provide auto services and product and services. Technology partnership is also very key across all the industries. So that's also very key. Agent network distribution collaboration is also very key. We had somebody from ethical funding, which we also identified that they partner with fintech and DFI to also drive a lot of partnership around ethical funding products and services that they render. So in terms of what institutional arrangements in place to promote collaboration. So interagency committees are available, especially for the regulatory guys. Interagency committees that allows relevant stakeholders to foster partnership, it's also there. They also do advocacy networking where they're able to identify and promote collaboration and also select partners. Development partnership like EFINA and GIZ was also identified. In some other sector, they do internal procurement. They have internal procurement structure through like an RFP, that is request for proposal process. They are able to select partners through that process. We also have other partnership qualification processes and through study of industry to also determine requirements in selecting partners based on the capability or the capacity of those of the right kind of partners for different kind of proposition. Then in terms of structure and processes in place to support collaboration, in some sector, membership of internal standard setting bodies, it's very key, where knowledge are exchanged, to support internal structures and processes on how to drive collaboration. Advert shortlisting panel
setting bodies.
International standard setting bodies. Pardon me, please. Then some internal processes like advert shortlisting, panel assessment for partner selection process, it's also very key. Monitoring and evaluation team are some processes that help review collaboration with financial service institution and other provide other internal technical support to also expand some of those partnerships. Also critical to some of the processes and structure are MOU, service level agreement, contracts that basically will define the terms that might capture maybe what commission structure, what are the responsibilities, and also help align the regulatory demands of some of the collaboration. Then of course, support structure is very, very important. In some collaboration, it also helps determine who is going to be who is going to drive support and who takes what, and all the necessary agreement, service level agreement that is required. So when we go into what the regulatory enablers and inhibitors that support or digital collaboration. So we identify, well, it's now I'm realizing that we have more inhibitors than enablers. So for instance, on the enabling part, the proposal for regulatory sandbox is there from CBN today. So we identified that as an enabler that will further enhance and promote collaboration in the industry. The global standing instruction, is also helping to reduce risk for service providers. And again, we had a debate around whether it depends on what angle to look at it, where if you go partner with a debtor partner, and at the end of the day, you have a joint account that, this then applies. So you could flip it the other way. It could be an inhibitor, it could be an enabler. Then policy development opportunity that, the regulation or regulators sent to all stakeholders to review gives an opportunity for people to make input into the document before the final regulation and release. We think that is also an enabler. Then in terms of inhibitors, we looked at the bureaucratic bottlenecks, like how long it takes to get approval for certain things to happen before you can get maybe a partner or even roll out product or even internal processes to even go ahead with partnership. Then we also identify unclear and ambiguity in some of our policy interpretation, or some policies are not very clear or they are conflicting in some cases, especially if you look at our KYC today in different policy document with different references and different interpretation. Regulation and governance on data sharing is also very critical. Some organization you want to collaborate with them, but because of certain approval you need to go through before you can expose APIs or data, customer information to them, it's also sometimes it's also a problem. Then we have some sectors. I think one of our team members that identified that I think I can't remember her sector now, but dual regulatory challenges, it's also very, very critical. We identify that they have a regulatory line to SEC, for instance, and some also to CBN. So sometimes it could inhibit some of their collaboration processes. Compliance of partners to all statutory obligation. While on your part, you might be compliant to all your necessary obligation in terms of tax and everything, your partners might not necessarily have all those, might not necessarily comply to all those requirements, and it might be an issue that will impact collaboration. Then when we look at what challenges do they encounter in the collaboration, institution challenge, legal challenge, and all that, we're only able to identify this one. Time was up, so we needed to just put something. Professionalism was identified. It was identified in terms of ensuring we put the right person, forward, when you're driving, because the person you're putting forward is most likely the face of your organization, and the knowledge and the resource, the capacity of the person might also swing in favor or in favor of the collaboration or not. So it depends on the technical know-how of the person that is the face of the collaboration. Commercial terms, sometimes it takes time. It's also a point of conflict between two organizations that want to collaborate. Then due diligence and default, all those funding was also identified. Then changing regulatory landscape is also a challenge, and timelines. So these timelines, it's about maybe we want to do this commitment on both sides. How well are we committed to meet certain timeline to ensure we go to market in the right time and things like that. That's all we have from our side. Thank you.
Thank you.
I don't know if any of my team wants to make commitments.
Okay. Yeah. Okay. Thank you so much, Group 2.
Group 3.
Sorry, Group 3. Apologies, Group 3. I apologize. So, Group 3, have you sent us this file, Mustafa?
Sent to Timothy. I've sent to
Timothy.
Timothy.
You sent to Timothy.
Yes,
okay,
right?
excellent.
Timothy. Yes.
Okay, excellent.
Yeah.
Group 4, are you there? Just in 1 or 2 minutes, because we're already 4 minutes over time. Group 4?
Yes.
Okay, so Mustafa, can you stop sharing? Thank you.
I'm sharing.
Yes, you're showing now.
Okay. Okay, Group 4. What we are able to deliberate to regard the questions postulated thus. On question number 1, we identify JVC and FMOs and then security aspect of collaboration, which are the type of collaboration that were identified. And on question number 2, we were able to come up with an issue of acquiring a platform and cost of acquiring that technology in a changing environment. And then also we talk about technology architecture in line with risk exposure. On question number 3, we talked about issue of signing MOU, SLAs, and pilot implementation with regard with partners and subsequent appraisals. And then we also talk about the issue of a robust IT platform and then choosing the right partners. And on question number 4, we talked about the agent banking regulators and then some institutional regulations, which are maybe we pick a CTF and MLA regulation as a case study. And then on question number 5, we talked about organizational structure and legal framework that need to be robust to encompass all aspects of engagement. I think that's what I have for, we have from Group 4.
Excellent, excellent one, Group 4. Okay, Group 5. Hello. Okay, Tobe, you can go ahead and give us the presentation. Go ahead, Tobe.
Well, for Group 5, we had some discussions. They were unable to answer question 2 before we went off. And just in addition to what other groups had presented, Group 5 decided to group types of collaboration according to the goals of what the parties are planning to collaborate on. So they grouped it as either it's a technical collaboration, maybe a collaboration of a skill, or legal collaboration, collaborating to get a license, networks, or collaborating just even to finance a particular innovation in the financial services space. And be put in place to support the collaboration. Apart from other things that have been measured, and I'm sure MOU was also mentioned in Group 3, to clearly define the rules of engagement, because as of question 5, one of the challenges raised by Group 5 as well was that sometimes you go into collaboration and then the other party doesn't fulfill their role or their responsibility. What should be the sanction if there happens to be another regulation that maybe chokes the environment for that particular collaboration? What is the exit criteria? How do we close down? How do we just cancel off that agreement? What are the timelines, milestones? Those are some of the structures and processes that must be in place for collaboration. And when we talked about regulatory enablers and inhibitors. One of the inhibitor mentioned, which has also been mentioned by other groups, is irregularity in regulations. So Saidi in our group explained that sometimes some regulations are enabling, and then when you go into the collaboration, another regulator releases another regulation that counter the objectives of the previous regulation. And one way to combat that, to be an enabler, is having an extensive stakeholder engagement, not just with among the regulators, but also between the regulators and other stakeholders. And when we're trying to identify some challenges, as I had mentioned earlier, the challenges of agreeing on what is the commercial model and revenue sharing modalities, who is bringing what, who is financing what, how do we share profits, how do we address non-performance, how do we properly analyze our strengths and weaknesses to be sure that one party is not just being laid back and then after the collaboration, only one party is carrying all the burden. And how do we ensure that our goals are aligned? Saidi gave us an example of people who tried to go into collaboration, but the other party really didn't understand what they were coming with because they were fintechs and didn't go into that collaboration. But right now, the fintech is making bringing in a whole lot of money, which they would have gone into to also leverage on that. So that's one of the challenges mentioned, proper analysis. So recommendation made again is still the same: extensive engagement, understand what you actually are going for, what is the strategic focus, what do you want to gain, why are you going to the collaboration in the first place, analyzing your profits and your loss. So that's just a summary of what we discussed in group 5 by way of the breakout session.
Thank you very much, Tobe. So group 2, are you still able to speak or do we move on? Okay, ladies and gentlemen, thank you so much for all your contributions. I'll call on Prof. David West to make any final comments in the next 3 minutes so we can close. Okay, all right. Prof. Sajai, do you want to make any closing comments, please?
Well, I think it's been very interesting, particularly with the methodology that some groups use, marriage and so on. I think for me, maybe we've seen a variety of collaborative arrangements, which seems to be okay. I think probably for me, the more important issue is this question: is there any deliberate effort or is there any intentionality in the organization to collaborate, to be on the lookout for valuable collaboration? Sometimes this may be cultural. Some organizations may prefer just to be organic growth. Some may actually be insular. So I think that's very important for growing collaborations. There must be some intentionality, some openness to leveraging on other capabilities, other players to create better value or greater value. And I really don't see why that should not become cultural in our environment. I'm not too sure it is, but from the perspective that in Africa, our default mode is to share. And we're talking now about the sharing economy. I don't know whether we haven't become too westernized, that competition is unduly emphasized and competition doesn't have sufficient traction. So I think that is something that may be an issue to overcome. I also hear the need for management buy-in in terms of processing or progressing collaboration. And that's very key. It comes from whether there's a deliberate intentionality to look out for how to synergize or even how to lower your costs. That intrepidity that is also willing to, to leverage on what is happening. So because if there's no management buy-in, it's not going to happen. And allied with that is the issue of governance, because the whole issue about collaboration is what are the governance arrangements, which just like the organizational level determines performance. And that's where the issue of integrity comes in. Do you, pretend to be what you are not? Do you promise what you are not going to give? And then if things are not working out, are you forthright about it, and so that everybody can, sort of retreat? Do we negotiate win-win relationships? I think these are important issues. If you look at financial service space, I think, of course, there's room for more collaboration in order to build a bigger pie. And I think that is something that we need to look forward to. Finally, is the issue of regulation. Regulation or regulators are a bit in a bind here, but I'm glad that quite a number of groups identified facilitative regulation, because we mustn't behave as if regulation is always an impediment. Yes. And so some mentions have been made of facilitative regulations. The problem, of course, is that sometimes if regulator is not proportionate enough, the regulator is not market-oriented enough, there is also the issue of lack of synergies between regulators, which ought not to be, because there's a body that's supposed to coordinate financial inclusion nationally, and even the National Economic Council is supposed to be involved. So why can't we make use of those institutions? So again, it's a question of intentionality on the part of the players, that's the operators, the regulators, and even the unit governments. I think that's something that we need to work on. My final take is that we do have very successful collaborations, in the financial service space. So let's major on and celebrate the successes. Talk about the payment systems, talk about the collaborations between fintechs, talk about even collaboration between banks, discount houses, and things like that. And I think in every country, there will always be those issues about competition, collaboration, then also trying to ensure that you do not allow people to collude. And I think the issue of consumer protection and the willingness of operators to have integrity, to give service, to protect the consumers, ultimately these are issues in the financial services space, which I also think need to be put on ground. But I was completely thrilled in the group I was, and in the discussions we've had. I think if we can, process this, the issue, of course, will then be how can we get that deliberate intentionality towards seeking out collaborations for win-win relationships for everyone. I want to say thank you for heeding our invitation. I want to say thank you for Kim and Tara for doing a fantastic job. Thank you very much.
Thank you so much, Professor Ajayi. Thank you so much for that wrap up. So Timothy, over to you.
Okay, thank you very much, Dr. Nkem. I think at this point, I would just like to say a big thank you to all our participants and to all my colleagues on the team as well. So like Dr. Nkem mentioned at the start, the slides and the summary of the presentations will be sent to us subsequently, and please look forward to it. Thank you very much, and we hope to engage with you once again very soon. Thank you, and bye.
And just before we log out, please, as a follow-up, we might be reaching out to you for some clarification as we try to build evidence in this body of knowledge. Remember, Professor David West had earlier mentioned that we can't really go into conclusion at the moment because we don't really have the data, as far as what the structures, the direction, and the nature of collaboration should be in the ecosystem. So subsequently, we will be reaching out to you, as follow-up to some of the conversations we have. And I hope that you'll be open to the collaboration to get data into body of evidence. Thank you, everyone.
Thank you very much, Emmanuel, for bringing that up. So, distinguished ladies and gentlemen, we'll be calling on you as we further build evidence and as we further define the structure and, build evidence around what the challenges are, and probably propose a framework for actually consummating, defining, and then entering into collaborations in this space so that we can ultimately have the right types of partnerships and collaborations that would help us achieve our financial inclusion objectives. Thank you very much, ladies and gentlemen. Have a wonderful afternoon. Bye-bye.